In this video we're going to explain what is cash flow and net worth. This is the second video in our series about financial education. One of the most important things in personal finances is to be able to measure and monitor one's financial position, and the pair cash flow and net worth give us the baseline for our financial decisions. I'll break these concepts down during the video, but cutting it short, the raw definition of these terms are: cash flow is the balance of money being transferred into and out of one's account, and it is calculated by adding all income minus all expenses. Net worth is the sum of all assets minus all your liabilities. Initially, these may seem to be the same thing, but they aren't. They complement each other, and an imbalance in one can create an imbalance in the other, hence the confusion. To explain these concepts, I like to use the analogy of water in a bathtub. Your income is the water supply for your finances bathtub, and your expenses are the water going out the drain. You can adjust how much water gets in the bathtub by opening the tap, getting pay raises, working more hours, adding extra income streams. Or you can close it by going into retirement, maternity leave, unpaid leave, working part-time. Up to a certain point, you can adjust how much water is drained out of the bathtub by controlling your expenses. The problem is, you can only try to plug the drain by covering it with your fingers, which means it requires work and constant attention, and no matter how hard you try, there is always going to be some water going down the drain. This is because your cost of living is never zero. Your net worth is how much of the water stored in the bathtub, your assets, you actually own. If all the water that you have in the bathtub came from your tap, which is your income, then all of its content is yours, and that is your net worth. But if you borrow a bucket of water to fill your bathtub quicker, for whatever reason, like a student loan, a car loan, mortgage, credit card, you need to deduct that debt, that liability, off of your finances bathtub volume, because that water doesn't belong to you. Cash flow, as the name suggests, is the overall balance of the water flow in your bathtub and gives you an immediate idea if more water is coming in than going out. It is a good short-term KPI, key performance indicator, and it is through checking your cash flow that you will know if you're spending more than you make. You should do a quick check on your cash flow monthly to ensure it is positive and plan yourself for situations where it may become negative temporarily. Your net worth is the total equity that you have. The higher your net worth, the richer you are. Tracking it over time gives you a good indication of your long-term financial situation progress. If your net worth is growing over time, you're getting richer. The interesting thing is that the size of your bathtub grows with your net worth, which means that there is always room for more water to be stored. You should calculate your net worth once a year and keep a log so you can track your progress towards your personal finance goals. Cash flow is by far the most important concept of these two, and the one that you need to have under control at all times. Having a positive cash flow will ensure that you have a positive net worth over time. Have a look at this graph showing the net worth and cash flow correlations. On the bottom left-hand corner in red, it shows the situation when you have negative cash flow and negative net worth. If you are in this stage, you are actually borrowing money from credit cards, from your parents, from the bank to pay your bills. It is like trying to fill the bathtub with the tap closed and the drain wide open. It's just not gonna happen, and you will finish with less than you started with. It is common sense that you shouldn't put yourself in this situation, but this actually happens to a lot of good people that just don't control their finances properly. If you happen to live paycheck by paycheck, you are a candidate to be in this situation. One day life happens, and an unexpected bill arrives, and suddenly you can't afford it all. If you don't act quickly, you are on your way to get buried in debt and even bankruptcy. On the top left-hand corner, in orange, it shows that if you have positive net worth but negative cash flow, you are deconstructing wealth. You are consuming your assets to maintain your expenses. This is a serious situation if maintained for a long time, and this is the quadrant where most retirees are at. No income and living off of their savings. This situation can only last for so long, and when you reach the point where you have eroded all your net worth, you have nothing left to sustain your negative cash flow. People in this situation end up in the red corner if nothing is done in time. On the bottom right, in yellow, it shows that if you have negative net worth but positive cash flow, you are paying debt down. You can be in this situation if you are recovering from being in the red corner, or for example, if there is a market crash and the assets that you bought using leverage, using debt, lose their value beyond the balance on your loan. Once your asset value is greater than your debt, you move into the top right corner in green. Now the green corner is where you really want to be in, because you're building up your wealth. You could still be paying down some debt, like mortgage or student loans, but your assets are worth something, and little by little, you will continue increasing your total net worth as you have more water coming in than you have going out. You can improve your cash flow by increasing your income, cutting your expenses, or a combination of both. For people who have very low income and that may be close to poverty, should focus on increasing their income, as their expenses are probably very close to the bare bone, or even under what would be needed for a healthy life. Income increase could be achieved by working overtime, doing courses that would enable going for higher paying jobs, and having a side hustle. It is really important to avoid increasing your expenses to match your higher income. Otherwise, you're not getting any better. People with high income usually benefit more from reducing their expenses, as many of the stuff they spend their money on are luxuries that could be trimmed down with minimal impact to their living standards. Fancy homes and cars can be downsized, holidays can be adjusted, and gadgets could be avoided altogether. Sometimes, by cutting an expense, you will temporarily increase your income. For example, you sell a luxury car that has a high maintenance cost and you put some money back in your account. You both reduce your costs and you increase your income for that period. It is very important to keep a positive cash flow. If your cash flow turns into negative, you should act as if your house is on fire. You don't take half measures because you're afraid the water will ruin your lounge. You put that fire out as quickly as you can, otherwise there will be nothing left. If you're enjoying these videos, please give us a thumbs up and subscribe to the channel. It really helps spreading this information to other people that may be in need. If you know anyone that needs to understand a bit more about financial education, please forward them this video link. Together, we can help many people. In the next video, we're going to go through a few examples showing how to calculate net worth and cash flow. It is really simple math and anyone can do it. See you then.